In January 2021, one of Wall Street's most respected hedge funds lost $6.8 billion in a single month, and the people who took it down were posting memes on Reddit. Melvin Capital had spent 7 years beating the market. Gabe Plotkin was considered one of the sharpest portfolio managers alive. Then in 30 days, everything he'd built was gone. And the part nobody saw coming was how ordinary it all looked right up until it wasn't. This isn't just a story about GameStop. It's a story about what happens when the smartest people in the room forget they can be wrong. Melvin Capital had real employees, analysts, traders, operations staff, whose livelihoods depended on the fund surviving. It had investors who trusted Plotkin with billions of dollars based on a decade of exceptional returns. And at the center of it all was a bet that looked absolutely airtight. Until it wasn't. The lessons buried in this collapse are ones Wall Street would rather you didn't know, because the same mechanics that destroyed Melvin Capital are still in play today, in your brokerage account, in the market you're watching right now. So how did a $12.5 billion fund, run by one of the best hedge fund managers of his generation, get erased in a month? Let's go back to the beginning. Gabe Plotkin graduated from Northwestern in 2001, and spent the next decade as a portfolio manager at SAC Capital, the legendary, controversial fund run by Steve Cohen, one of the most successful traders Wall Street had ever produced. Plotkin wasn't just good, he was exceptional. Cohen trusted him with hundreds of millions of dollars, and Plotkin delivered year after year. In 2014, Plotkin launched Melvin Capital, named after his late grandfather. Steve Cohen was one of his anchor investors. The fund started with roughly $1 billion in assets and grew to over $12 billion by 2020, posting returns that ranked among the best in the industry. Up more than 50% in 2019. Up more than 50% again in 2020. That track record bought Plotkin something dangerous, total confidence in his own process. And his process included a large, persistent short position in GameStop. A short position is a bet that a stock will fall. You borrow shares, sell them at the current price, and plan to buy them back cheaper later. If you're right, you pocket the difference. If you're wrong, your losses are theoretically unlimited because a stock can keep rising forever. GameStop was a dying brick-and-mortar video game retailer. In mid-2020, its shares traded around $4. Melvin Capital and several other major hedge funds had shorted it heavily. The thesis was clean: GameStop is obsolete. Everyone buys games digitally now. The company is heading toward bankruptcy. Short it, wait for the fall, collect the profits. It looked like the easiest trade in the world, but it gets worse. By early January 2021, short interest in GameStop had reached a number that sounds like a typo. More than 140% of the available float was sold short, meaning short sellers had borrowed and sold more shares than actually existed in the market. It was an overstacked table, and a small, very loud community on Reddit had noticed. r/WallStreetBets is a forum built around high-risk, high-conviction retail trading. In the fall of 2020, a user named Roaring Kitty, real name Keith Gill, had been posting detailed analysis explaining why GameStop was undervalued and why the extreme short interest created the conditions for a squeeze. If enough buyers pushed the stock up, short sellers would be forced to buy shares to cover their positions, driving the price higher, forcing more covering in a self-reinforcing loop. Most professionals dismissed it. They'd seen retail investors talk about short squeezes before. It was noise. It wasn't noise. On January 13, 2021, GME closed at $31. By January 22, it was $65. By January 25, $76. By January 27, the peak GameStop was trading above $480 per share. Here's what they missed. Plotkin's team had access to real-time data. PhDs, risk management software, and decades of institutional experience. What they didn't have was a playbook for retail investors coordinating at scale through social media, buying call options that forced market makers to purchase shares as a hedge, and holding with the explicit goal of inflicting losses on the other side of the trade. The squeeze was unlike anything the models had seen, because the models had never seen exactly this before. Melvin Capital's losses were catastrophic. By January 25, Citadel LLC and Point72 Asset Management had wired an emergency $2.75 billion into Melvin just to keep it operational. The Wall Street Journal reported the arrangement as a revenue share deal rather than a straightforward equity stake. Translation: Plotkin was desperate enough to sign away future earnings just to survive the month. Plotkin later told Congress he had closed Melvin's GameStop position by January 27 at a significant loss. The total damage for the month, approximately $6.8 billion, a 53% drawdown in 30 days. But this wasn't over. The bailout stabilized the fund in the short term, but the structural and psychological damage was severe. 2021 became a grinding, humiliating attempt to rebuild. It failed. Melvin finished the year down roughly 39%, while broader markets posted strong gains. Investors who had trusted Plotkin with capital watched a decade of outperformance get erased in 12 months. 2022 brought more of the same, another 39% decline. The capital base, already decimated by redemptions, shrank further. The track record that had taken a decade to build was in ruins. In May 2022, Gabe Plotkin sent a letter to investors announcing he was shutting Melvin Capital down entirely. He acknowledged the losses had been too severe, operationally and psychologically, to recover from. The fund returned remaining capital. One of the best-performing hedge funds of the prior decade finished. So what do we actually take from this? Lesson 1. No short position is safe when the crowd is large enough and organized enough to move faster than your exit. Short sellers depend on price discovery operating at institutional speed. In January 2021, it didn't. Retail investors with brokerage apps, options access, and a coordinating forum moved in ways the models simply weren't built to anticipate. That dynamic is embedded in market structure now. It doesn't go away. Lesson 2. Extreme concentration in a single trade creates catastrophic tail risk. Melvin's short book was large, visible in regulatory filings, and mirrored by other major short sellers. That made it a target. The same principle applies at any scale. Positions that are too large and too transparent invite adversarial behavior from people who have nothing to lose and everything to gain. Lesson 3. Past performance is the most dangerous form of overconfidence. Plotkin's track record was genuinely extraordinary. That track record was also why he was managing $12.5 billion, which was why his losses were $6.8 billion, which was why he couldn't recover. Success compounds, so does exposure. The people at Melvin Capital didn't set out to blow up a fund. They made rational decisions inside a framework that had worked for years. The framework failed because the world changed faster than the model. That's not unique to hedge funds. It's the same thing that has happened to every investor who ever said, "This always works," right before it stopped. You can't guarantee the right call, but you can know which calls carry asymmetric downside, and that awareness is the only edge that actually compounds over time. If this breakdown made you think about the positions you're sitting in right now, the ones that feel like a sure thing, it might be worth taking a closer look at what you actually own. Webull gives you 90 days of commission-free trading while you stress test your own book. Start at Webull.com, and if you want more forensic breakdowns like this one, the mechanics of exactly how smart, well-funded people lose everything, subscribe. New deep dives every week. And the next one covers a collapse that makes Melvin's $6.8 billion look like a rounding error. Last question, did Melvin Capital lose because retail investors gamed the system, or because the system finally worked exactly as designed and it just happened to work against them for once? Criminal, or just the market? Tell me below. And save this one. The short squeeze mechanics we covered here are going to be relevant the next time you see a stock with extreme short interest sitting in your feed.